What's up, everybody? Nike just released their fourth quarter earnings last night, and the market apparently loves it because stock is up about 14% right now. So let's take a look. Is Nike an opportunity, or should we stay away? Now, this is the fourth quarter for Nike because their fiscal year ends at a rather unusual time. And just as we're starting, the stock is now up 16%. So first, let me just say, never feel like you have to rush into a stock or rush out of a stock. If a stock is shooting up or it has some massive drawdown because of some event or earnings, just relax, go make yourself a tea or something. When we make investment decisions, you want to make it with a really cool head. So let's get into this. It hasn't been a fun few years for Nike. Their stock at the end of 2021 was about $170 a share, and now it's just $70 a share. So they're down about 60% even after this pop today. Of course, over the long run, Nike has been an amazing winner, but their stock today is really just about where it was, 7-8 years ago. So let's jump into a sheet, take a look at some of the fundamentals. The earnings revenue has been steadily increasing over time, but they've hit this rough patch the past few years. Revenue's down a bit, operating and gross margins have been under pressure. And with these premium brands, you definitely want to look at margins. I mean, anyone can make a shoe or a t-shirt, so what makes Nike special? It's the brand. When a brand is very strong, you see that in the numbers because they're able to increase their prices and the gross margin on their products is going to be higher than their peers. So let's dive into this report. When you go to their investor relations page, the first thing you see is Nike is a growth company. Now, typically, most growth companies do not have to proclaim this in big letters on their IR page. I think Nike is really more trying to convince us, because just looking at the earnings report, it's been kind of a rough year. Their revenue, so the top line here, is down 12%. Shoes are down about the same, 13%. And this is really the heart of Nike's business. I mean, when you think of Nike as a brand, yeah, they make other stuff. They make t-shirts, they make all sorts of sportswear, but shoes has been about 2/3 of their business, a little bit more. Nike is really a shoe company, and there's a lot of competition in that space. Now, when I was growing up, everyone wanted Nikes. Nikes were the coolest shoes. I still think Nike has the strongest brand, but it's my sense that there's just a lot more competitors. Now, I might be a bit biased because the most recent pair of shoes I bought were Brooks. Before that, I bought myself a pair of Hoka's. And when I was trying shoes on, I just didn't like the Nike shoes as much personally. And this is definitely somewhat subjective. So if you have an opinion on this, leave it down in the comments below. But to me, the cool factor of Nikes has waned a little bit. I don't get the sense nowadays that Nike shoes are cooler than Hoka shoes or On or Brooks. I think it's still arguably the strongest brand. I just think the power of that brand, the difference between them and everyone else, it's less than I feel like it used to be. And you're sort of seeing that in the numbers. The gross margin has dropped a lot. I mean, gross margin dropping down to 40%, that's a pretty big hit. Now, they mentioned some headwinds like tariffs, but tariffs are not accounting for 400 basis points of margin compression. For what it's worth, management said on the call that they expect tariffs to be about a 100 basis points, so 1% headwind for them on their margin in the first quarter, and that to mitigate a little bit throughout the year. I think they're looking at about 75 basis points of margin headwind from tariffs for the next fiscal year. But just going through this money flow chart here, another thing that's a bit of a red flag is, so margins are coming down, revenue is coming down, but you don't have expenses coming down. In fact, expenses are up. Expenses are up just a little bit year over year. So the net result is that earnings are basically nothing this quarter. Just comparing this to the same quarter a year ago, we see that gross margin down more than 4%, gross profit down 20%, and look, expenses up. Just by the numbers, this is a pretty ugly report, but the market is always forward looking. So earnings, this is looking at what's already happened. The market is trying to price in what's going to happen. And it seems the market is pretty happy with what management was saying on their call. They said, we expect quarter one revenue to be down mid-single digits. And again, quarter one, that's the next quarter for them. They start their fiscal year at an unusual time. They said they expect gross margins to be down, roughly around 4%, 400 basis points. So quarter on quarter, that's kind of similar with where gross margins are now. And they're also saying they expect expenses to be up a little bit. So they're not really giving specific guidance, but they basically imply in the whole call that the next couple quarters, the first half of their 2026 fiscal year, is going to be under pressure. It's not going to be great. But they also say on the call that they think that this is about as bad as it gets. They think the bottom is in, and they think that they're going to return to growth. And I guess that's the story that the market is believing, because clearly the stock is up a lot right now. But just for me, looking at the numbers, I'm not sure I'm really convinced. I mean, if we go down also, just breaking it down by geographies here, we see they're under pressure across the board. North America, this is their biggest market, and this is where they're probably facing the most competition from Hoka and On. Here's a big number that stood out to me too. China down 21%. This is an enormous drop in the Chinese market, and I'm a little concerned that there's a shift in sentiment in China away from Nike as a brand. The word China appears 18 times on this conference call, and they highlight, for example, here, our holiday order book is up versus the prior year with growth in basically everywhere. So that's the good news. That's giving credence to them saying, we think the bottom is in. We think that wholesale is going to come back strong in a lot of these geographies. But then they say, offset by China. We're not seeing this in China. They use language like, in Greater China, we're still cleaning up the marketplace with the nuance of it being a mono-brand marketplace. Mono-brand marketplace, what they mean by that is their sales are coming from Nike branded things, Nike stores, which in China are operated by a company called Posheng, or the Nike branded site on Tmall, which is Alibaba's online marketplace. Their sales aren't really coming from multi-brand retailers like in the US, where we have Foot Locker, you have Dick's Sporting Goods, you have all these wholesalers. Wholesale is still the majority of Nike's business. So in any case, bit of good news, bit of bad news. Let's take a look at what we can expect on Nike as an investment going forward. Is this a good investment today? Well, I made some assumptions down here. So their top line revenue growth, they have grown about 6% annualized over the past 10 years. And even though, again, right now we're looking at a decline of 12% year over year, I'm assuming that they can get back to growth. I'm assuming low to mid single digit growth. I'm assuming that they can stop the bleeding in their margins, that their margins are not going to deteriorate more. And for a multiple, I gave them a 16 times multiple. They have traded above that for pretty much the entirety of the past decade. Previous decade before that, this is basically in line. What do you think is fair for a company that's getting low growth, might have margins coming under a bit of pressure? Even if I give them an 18 times multiple, you're looking at a 9% annualized return from here. So that's okay, but it's nothing incredible. And as far as a bear and bull case, in my bear case, I'm assuming that revenue just stays flat. They are not able to return to growth. I'm assuming margins are, under pressure a little bit from here. This is just a slight reduction for where they're currently at. And for a company with no growth, giving them a 10 times multiple on operating earnings is not unreasonable. You might say Nike is such a strong brand, it's ridiculous and absurd to give them a 10 times multiple on their operating earnings. But let me just remind you that companies like Microsoft, Apple, Meta have all traded for multiples of 10 times their operating earnings or less within the past 15 years. And if my assumptions in this case come true, you're looking at a fair value for the stock that's like half of what it is today. Now, as far as a bull case, if they return to high single digit growth, and if they return operating margins to kind of where they were at their peak, and they command, a premium valuation here, then you're looking at 22% annualized return on this stock, which would be absolutely fantastic. So if you're looking to buy Nike stock today, you have to look at these scenarios and you have to ask yourself, what do you think is most likely? And for me, I'm not saying that Nike looks horrible from here, but I just don't see it. I don't think I'm getting good enough risk reward. And just to show you a quick comparison, let's look at Deckers. So Deckers owns Hoka. The Hoka brand makes up about half of Deckers' revenue. So it's a huge part of the company. Deckers also owns UGG. So this is kind of a shoe company as well. It's definitely comparable to Nike. And in just a moment, my sheet is going to bring in a bunch of fundamentals for Deckers. We see their stock hasn't been fun over the past year. Year to date, they basically dropped 50%. They were in the 200s, now it's just about 100. But look at this, just insane revenue growth. Hoka's has really taken off. Their margins have gone up. Hoka's is a higher margin part of their business than the other parts of their business. So as Hoka's have taken off, their margins have really improved. And right now, this company is trading for just about 12 times their operating earnings. So Deckers has better growth, better margins, and a lower valuation right now than Nike. To me, I just don't see a reason why I would invest in Nike stock today. And let me just be clear, I don't own Deckers either, but it is a company that I'm looking at. I really like Hoka shoes, so I may be biased. We might do a deep dive into Deckers in a future video. But regardless, let me know. Do you agree with me? Do you disagree with me? What do you think about Nike stock today? Is it a buy for you? If you got something out of this video, subscribe to the channel. We're almost at 250 subscribers here, so thank you so much to everyone who has subscribed. And let's just look, where's Nike stock right now after finishing this video? Still sitting on about a 15% gain on the day, so congrats to everyone who's invested in this. I hope it continues to do well. Don't wish anything bad for owners of Nike stock, and I hope to see you in another video.